Everybody, happy Sunday. Welcome back. This is Chris Pulver here. Happy Sunday night. It is 7:31 p.m. Eastern Time, September 15th. Let's take a look at the markets. We have a big week ahead, all about the Fed, all eyes on the Fed. And that's going to be Wednesday. A lot of things flipped around last week with the rate cut expectations between 25 and 50 basis points. It's now pretty much coin flip. The markets had a big rip. We also have it's considered triple witching on Friday, where we have the typical weekly expiration plus monthly expiration. We're going into the end of the quarter as well. So a lot of stuff to get priced in, see what the market's going to do. I think it's going to be kind of a wait and see as we get to Wednesday, but I would expect the market to be relatively calm Monday, Tuesday, maybe a little jockeying here and there, but really it's going to be all the fireworks, floodgates open up for volatility Wednesday, and then Thursday, Friday, of course, the aftermath. So if you're out there typing a wire, yes, everything's coming through loud and clear. We can keep the session short and sweet, probably 20, 30 minutes. But there's plenty to digest this week. So here is the SPX. Here's the daily time frame. Last week was pretty wild on Wednesday. Wednesday was a big, massive intraday move. One of the largest swings I've seen, intraday in a long time. Here's a good way to take a look at that. And then also having a look at this other website here. This guy. All right, so I've got some chart ups going off. Hopefully you can't hear that, but if you can, it'll be over in a moment. This was last week's price action. So you can see Monday pretty calm, Tuesday pretty calm, Wednesday big drop to the downside right at the open. We had Wednesday CPI news print. We had a huge daily reversal on the S&P where it came down to fill the gap from the post-Labor Day sell-off lows. Nice little double bottom right in there, and the market ripped all the way back up very near to the highs once again. We are not quite at the all-time highs. You can see here back in the middle of July, all-time highs. The end of August made a heck of an effort to get back to those all-time highs. Starting out September, trying to get back to those all-time highs. And of course, we're coming into the Fed this week. Is the Fed able to get the market over the finish line to all-time highs? Is that a bull trap that's going to end up failing? Or is this week's volatility going to be a lot of noise? And then the market's going to have to play one way or the other as we get through September. I have said this for the last several weeks now, going into this month. I read an interesting factoid this weekend. Let me try to find it here. Obviously, the market can do whatever it needs to do, but there's been an interesting study. Let me see if I can find the info here. It was something where the market's like 0 for 10 anytime we've seen a rough start to the month of September. Let me find it right in here. Where is it? Man, we got a little storm whipping through here in Salt Lake City. No, no, no. Interesting. Well, it's in there somewhere. All right. Well, I will find it. But basically, the probability says it's going to be tough for the market in September to finish green. Okay. So let's actually take a look at the monthly candle, because right now, look at what August and August and September have looked like so far. You talk about buy the dip. I mean, that August 5th bottom, ripped all the way back up. Market tried to close near those all-time highs. We started out September with another, 4, 5, 6% correction, and we've ripped all the way back to those highs again. So, yeah, obviously the market does what it needs to do. I'm going to go into this week looking out further than just this week. So, any trades that I'm taking are probably going to be based in. I might take a couple of short-term trades out just to Friday and see if the market's wild and crazy out to the 20th. And then I'll be looking to take some trades out also through the 30th and the 4th. Really just volatility plays would be fine by me. Something to this effect, if I were to, buy a call to the upside, buy a put to the downside, sell and kind of cap that, I would give myself more opportunity for profit to the downside. I think that's where the bigger risk lies right now. So I will take a look and kind of construct these trades tomorrow morning. But if I did something on ES or on SPY, Qs, I might even get the DIA and the IWM in the mix, but I'll probably trade just SPYs and Qs for a little volatility play for the next couple of weeks, and maybe give myself, maybe $10 to the upside and then 15 to 20 to the downside. I want to see what something like that's going to cost me to go out a couple of weeks. Volatility is a little bit elevated, but the VIX has been down. So here is the VIX at 1657. So the VIX retreats off its 2360 highs after that Labor Day sell-off. We have the S&P just within. I think we're within 1% of the all-time highs. All-time highs about 0.5% away. Go to the Nasdaq. We're obviously much further off those highs. Nasdaq looks like it could rip a little bit better than the S&P, but I just want to be conscious that we don't necessarily fall for the old bull trap, which would be, price melts up and then post-Fed, the price just crumbles and we struggle to break this high. So I do want to see that this week's settlement between a daily and weekly candle. So daily candles Wednesday, Thursday, Friday, for out here in open space. But I want to see how the weekly candle closes, because if we end up finishing the week with a, big bull week and it takes out previous highs, maybe tech is looking pretty good to try to get to these all-time highs. Maybe the S&P and the Dow are actually up to all-time highs. Maybe the Russell plays catch up as well. But for whatever reason, if we see a fake out rejection on the Nasdaq, fake out rejection near the all-time highs in the S&P, if we did a little rip on the Dow, all-time highs is not that far away. Again, very close to testing that last week on the close Friday. If we have a fake out, I could see this where the Dow goes higher and then fades. Maybe something in the middle of this range where we have highs, 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 lows, lows, lows. You can acknowledge, we have highs for resistance, lows support, and then the halfway point where price could also use that as kind of stability. You can see some nice support in there as well. Go to the Russell. It looks very similar to the Dow, just not at all-time highs. Russell, ripped pretty nicely off these recent lows from Wednesday's turn. Had a Thursday, Friday follow through up 6.27% in just 3 days of trading off those lows, but quite a bit off of this high that we had back in July, and still quite a bit off the highs all time, which are back in late 2021. I still like the Russell. I have some trades in here, some bull put spreads on the Russell. If it just is choppy and volatile in here, that's fine. But I want to see if price will stay bullish and then have a chance to get to these highs, possibly get into the all-time highs by the end of the year. Okay. Volatility, as I said, retreated a little bit off of the Wednesday rip last week. Dollar index, this is what I'm staring at. I don't know if the Fed's going to bring any pain, any noise, anything on the dollar going into next week, but this is something I'm keeping a very close eye on. The dollar's in a multi-year range with support here back around the 101 handle. We had a bit of a fake out here at that 100 handle, and again here at 101. Again here at 101, it actually was a low around 100.50. Again, where does the dust settle? Where does price action, tell us to go? Is price breaking lower and going lower? Are we actually going to see, a trend in a summer breakout where all this consolidation is yielding a weaker dollar? Or is this going to be the tone shifts? The Fed maybe is not going to be as aggressive as cutting. The market's thinking the Fed is going to be just ridiculously bearish, or ridiculously dovish. And we don't know that, right? We don't know what the Fed's going to say on Wednesday. We do know that the probability is 50-50. So this may be shifted slightly. Look at this crap. This is nonsense. It's just insane how much this has changed in the last week. Literally, like Monday, Tuesday, Wednesday last week, this Fed rate decision for September 18th, which is this Wednesday, this 25 basis points rate cut was up into the 80% probability. And now it's actually less than what we're seeing now. Like way less. I mean, now the market's thinking these guys are going to cut 50 basis points. I just have said this for the last couple of weeks, like be careful what you wish for. The market historically with a 50 basis points rate cut has not done well for stocks. So if the Fed comes out swinging with 50 basis points, the only thing that may stabilize the market by a 50 basis points cut from Wednesday is if they push back on cuts for November and December, right? Because if they just did 25 for September, another 25 in November, another 25 or 50 in December, as data proves and supports the idea that they can continue to cut, maybe that's better. But to just come out after terrible employment news we had during Labor Day, right? Meaningful inflation data where we had a 2.9 CPI year over year to a 2.5, U of M inflation readings at 2.7. I mean, inflation is trending lower, yes, but I think the argument out there is that it's still going to be quite sticky. I mean, shelter's lagging. Shelter's been coming down. Pay at the pump and gas prices have been coming down. Oil's down 20+% in the last couple months. All these have contributed to inflation trending lower. But unless we have a full-on oil crisis, we're probably going to have some sticky support on oil. That's going to bounce around price a little bit. That's going to stabilize. Inflation is probably going to be. I wonder how long it's going to take to actually see a year-over-year print out of U.S. CPI get to 2% or lower. Probably months away from now. So one more round of employment news, one more round of inflation news. Does that give the Fed all the confidence in the world to keep cutting aggressively? I don't know. So, like I said, this was a really big shift from last week. High 80s in probability. I saw it as high as 87% last week. And then after Wednesday, Thursday, this thing shifted in a big way and all of a sudden became a coin flip. So I will be positioning for that this week. I think Monday, Tuesday is going to be a bit of a calm day. Wednesday morning may be calm as well. And then bring on the fireworks Wednesday, Thursday. Expect some volatility. I think the market's going to rip one way or the other. I really don't know. But I do think that more risk is to the downside. If we have big direction, I think that risk is more to the downside than it is to the upside. But that's just my personal opinion based on where we're priced, based on price to peak earnings, based on the overall price to sales in the S&P. We're not in earnings season right now. That's still a couple weeks out to start off with financials. So really, the Fed right now is the big catalyst, and the news is kind of it. We're through the news cycle right now, and we have to figure out where price is going to take us into the rest of the month. Okay. Correct up, then sell down, inverse gold. Yeah, we'll see. I mean, to me, this makes sense that the dollar. I mean, if we look, it's pretty simple, right? If the stock market, does a little bit of a prairie dog and then sells off, and so we have like a fake out up, and then the market rips lower in the stock market, I do expect the dollar to make a decent bid to the upside and probably come back into the halfway point of this range. This lower high may also change. This might be just a straight up range from support lows to resistance highs, and if the dollar gets bid in here, I would be looking to, buy the dollar with tight stop losses, trailing stop losses, moving to break even or better, and then looking to see if price wants to head up. And, where does it go? I think halfway point is an easy target for at least a cover, where we have a bit of a short squeeze, where everyone that's been super bearish on the dollar is getting pushed out of positions. But I would be looking to then fade the dollar once again, or certainly fade the dollar once again here, unless we're noticing the stock market is dropping in a big way, but I don't think that it will. I think it's going to be a lot of noise, a lot of volatility. Buckle up because we're going to get it this week. Okay? All right. So that's the dollar. Let's go to oil. Oil had a nice little bid last week. Lows around 65, came all the way back up towards 70 plus. We're going to see if oil will stabilize here on $65. Here's CL. I got filled on a credit spread last week, 65.50 by 64.50 for 50 cents. All I need oil to do is stabilize and stay above 65.50. Natural gas, I'm looking to see if natural gas will come back down to under $2. Maybe looking to take a play at the $2 handle, maybe down here towards the $1.70 to $1.65. Just credit spreads probably on the natural gas futures. Gold had a nice little 2-day breakout last week on, I believe that was that Thursday? What was that daily trading candle was the 12th. The 12th of Thursday. Yeah. So Thursday, Friday breakouts on gold. I am seeing some overstretched conditions on gold. Here you go. So my MACD, my relative strength, we are getting back into overbought territory. Let me see here if I can put on, go. I'm going to throw that on here and then change this up. So let's go settings, 2120. That's not what I wanted. I'm going to double check the look back on one of my other workspaces. Actually, I'm going to delete this for a second. So we have gold at fresh highs. We have MACD histogram showing divergence. We have from these highs over here back in May and June, we have the relative strength also showing divergence. Now, this does not mean I'm calling a top in gold, but I could see gold from this recent breakout. I could see this as a fake out, come back to retest, or gold pushes down here, allowing the dollar to maybe catch a bid, right? If gold comes down low enough, I'm pretty interested in, coming back into my, Bollinger Band support levels, or my 21 EMA, or my Keltner lows, or even this good old 200 moving average in red. And I've said this for the last month or so, gold has not seen a touch of the 200 EMA since October of last year, and that gets us now about 239 bars away. Now, that's not a super overextended move for the daily time frame, but it's enough so that I'm paying attention, where I think that gold might just continue to go sideways and let this 200 EMA catch up. But for me to take more buy trades, to catch more bids and go into gold futures or go into GLD or buy more shares, I would like to see a pullback in gold if I can get one. So on the upper side of this Keltner channel, I'm looking to see a price will pull back to the midpoint or find support, or of course find that 200 EMA, and I'm looking to get long on gold. But I'm not shorting gold. I'm not. I'm just going to hang on to it and see what it does. If it pulls back, great. I want to see a pullback. Silver looking a little bit better for me. Silver, same type of thing. This is a good price action play on silver. I am long. Silver is one of my better performing positions, as well as one of my better allocations in the portfolio. I like silver to the upside. I may also add some additional SI trades, which is silver futures. And I might add one right in here or right in here for a little bull put spread. If silver heads up to my target, which is measured on 35.88, I have trades of SLV. I have naked puts on SI. I have credit spreads on SI. I have long calls on SLV. I have long calls on SI. I'm trading quite a bit on this position where I'm not done either. I mean, if we get to 35, that's to me just a measured move. But if we have wave 1, 2, and this is still kind of in the works of wave 3. Wave 3 to wave 4 would be a minor pullback. And hopefully this is the wave 5 that I'm really going to cash in on my silver position. So I'd say like $45 to $48. That's where I'm taking a majority of my profit. Let's just talk percentages here. If I get a move on silver to hit my profit target, that's another 55% in gains. That should be pushing close to almost $100,000 in profit on silver. So I'm going to cheer it on, and I'll be watching price and seeing if I can add some more to it. So maybe another 1 to 2% allocation on silver. But I've said this for probably 3 to 4 months now, maybe most of this year. I like silver better than gold. I think technically it's easier to measure. I think technically it has room to outperform. If we go to gold versus silver, silver versus gold, so XAU, XAG, right here, over the last, let's say, couple of years, I mean, this is July of 2022, we have seen pretty much gold and silver range bound. And if we're starting to see that silver gets the upper hand, this is gold versus silver. So if this chart starts to head lower, that's actually good. We could see silver outperform to some percentage. I don't know. Let's find out. If that goes down to this low, we might see like a 10% outperformance in silver. I would certainly cheer that on. Bitcoin had a rip up to 60K last week, or nearly 60K. It's pulled back a little bit over the weekend, but we had highs around 60,700. And I still like Bitcoin for the price action it's given us. It looks like to me this is just a massive accumulation area. But I'm going to be watching to see if and when do we break out from a recent high. So we can see we've been making lower highs. All right. If we head back down on Bitcoin, we may even strike a lower low. So I'm just going to watch this structure to see when we get a bull pattern to then start getting long. If I don't see this, if I see price just starting to go up higher and we're breaking this trend line right here, a little bit of a pullback, I may take another stab right around this 60K handle. Small position at 60K, small position at 50K, small position at 40K, and then position here at 30. I'm still willing to dollar cost average in to Bitcoin, longer term, medium term. I'm just trying to see if we're going to break some highs. Dollar starts to get weaker in the bigger picture. Fed starts to cut rates. Asset prices look better. Everything can rally. If we have a weaker dollar and we have an up stock market, everything can rally. Risk appetite returns, everything can rally. Bitcoin is certainly in the narrative for, risk appetite. And we're going to see, do the Qs. I mean, the Qs are well off the highs, partly because a bit of the AI, the AI hype and the AI, not bubble, but the AI hype is kind of played out and it's stalling for right now. Nvidia can still do whatever it wants. The margins on the semiconductor space is still really, really great. But I'm not all in on semiconductors. I think that's been a great trade this year, but I'm certainly shifting elsewhere. I think there's things that have been beat up and underperformed that are better priced. There's better price tech. There's better price utilities. There's better price defensives. There's better price a lot of things other than just buying, Mag 7. So anyway, Bitcoin, watching price action very carefully. I like the levels in here. If I can see a 50K or 40K tested, I will be adding to my Bitcoin. 30K would be pretty much like a dream price at this stage, unless of course we just have just straight risk off trading, and then that's like, well, maybe I'm catching a falling knife here, and maybe we settle back into like 20,000. But the one thing I've been watching too is the Bitcoin mining costs are sitting around 73,000. So if I go to mining costs, let's go Bitcoin mining costs. Let's see, April 6th, 49, Coinbase, this one right here, this macro micro website. See if I can zoom in. So right now, the Bitcoin spot price is around 59,422. That's according to this chart. We got a Bitcoin price here at 59,139. The mining cost is sitting right around, the average Bitcoin mining cost is 78,534. So I think, we're kind of on sale. It's it's a minor sale, but it's still, I mean, we're talking $18,000 cheaper at spot price than it is mining at 78. So if this, I mean, obviously you can justify like I'll just buy it and take it up to 78. I mean, that's fine. We play catch up. But I'm looking at this price action here. If we go a little bit lower, I would like to see. I mean, look, this swing low to high. If all we had was a nice little 50% zone to, let's say, like a 78% zone, this would be where I'd say I'm the most bullish. If we have an opportunity to buy Bitcoin in this area, that's where I'm going to be the most bullish. As far as, maybe allocating another 1, 2, 3% of my portfolio to Bitcoin to be somewhere in here. Because if it's this area, we just start going higher. I mean, okay, I'm already participating. I've got 3 to 5% exposure. Personally, I've got about 10% exposure. I'm good with that for right now. But if it comes back and gets a little bit cheaper, I'm willing to allocate a little bit more for the potential asymmetry to the upside. Okay. 70K shorts, maybe take them down before. Yeah, maybe. We'll see. I mean, if it's a flood up here, like we again, test the highs at 69 to 70, that gets everyone excited, but it's, again, bit of a fake out trade. If we hit that resistance and then fall back down, I could see that happening for sure. Okay, MicroStrategy, that's essentially like trading Bitcoin. Michael Saylor and co. putting it on the treasury. There's a couple of the companies that are doing the same thing. Ethereum, some pretty good support here at 2,100. I'm looking to see if Ethereum can get back above 2,800 highs. The Japanese yen made some fresh highs last week, so we had a stronger yen. If you're watching FOREX, I don't know if this is necessarily overbought, but the Nikkei, I would like to see this. Maybe this is wishful thinking, but with a 27% swing from high to low, I would like to see if the Nikkei can do something along these lines: high, low, lower high, lower low, and then from there, probably looking to buy the Nikkei. Okay, there's a nice little harmonic pattern somewhere in here, or you could switch that around and go high, low, do a little harmonic pattern this way, and then the market sells off. But I would think right now, if the Japanese yen gets a little bit stronger for the month of September, especially, we have some type of harmonic pattern this way. Buying in, let's say around 33,000 on the Nikkei, or the 27% crash low at 31,000. Give it 6 months, give it 12 months. I think the Nikkei is going to be higher than where it is at those lows. So how could I do it? I could trade EWJ with credit spreads. That is a ETF. I could trade this for cheap, right? I mean, that crash low was $60. If I bought at 65, bought again at 60, and just kind of let it sit. This also excludes the bottom 15% of the Nikkei 225. So I'm not saying that that's 210 stocks that are crushing it, but if you have a little bit more concentration, excluding the laggards, then perhaps it's a little bit more stable. But also depends on liquidity. I'm not sure. That's why I probably use options on EWJ versus just buying shares, because who knows if it's liquid. All right. FTSE and DAX just off the recent highs. So Germany off the highs just a little bit. FTSE in the UK just off the highs. Hang Seng in China, still this big sleeping dragon in my opinion. I like China to the upside potential. They just have to be willing to take on debt. I mean, that's really what it is. The U.S. has grown solely because of debt. I had this interesting podcast this weekend. Right now, the debt growth for the U.S., the fiscal spending, the monetary policy, the dovishness, it takes about $2.50 of debt to give $1 of GDP growth. So you can say it's a little bit inflated. You can say it's a little bit artificial, but debt is what's been kicked down the road for a long time. It's the can that keeps on getting kicked. And yeah, I mean, there's also waves of inflation cycles, and we're in like wave one. So long story short, I do think China has good technical setups, but fundamentally, you have a regime that doesn't want to really support the economy. They're certainly not doing it with debt. They're not bailing out the real estate sector. They're not bailing out the tech sector. They're talking it, they're jawboning it, but you're not seeing it relative in prices right now. And one kind of easy adage is, are they lifting animal spirits? The U.S. It's been all Mag 7, all AI, lifting animal spirits. Last week, the market breadth for the U.S. market was actually pretty decent. A couple of days last week, like Wednesday and Thursday, we had about 70% of stocks advancing. That's pretty high. So market breadth is returning in a pretty nice way. The Russell actually outperformed a couple of those days on Wednesday, Thursday, Friday than it did elsewhere. So that's pretty nice to see that the small caps are playing a little bit more catch up than the large caps. But again, I say all that because China's still pretty quiet for right now. Mag 7, talk about bonds. I'm still long TLT. I don't know how much longer I'm going to stick with this trade. I've got a sell call against my longs at 103. I've got a symmetry play up to 105. If we hit 105, I'm pretty much out. I could care less what bonds do. Honestly, I'd rather have gold in my portfolio than bonds. I'd rather have Bitcoin in my portfolio than bonds. I'd rather have corporate bonds in my portfolio than U.S. bonds. If I was in the tips bonds, maybe. But I just think that if you go back and do a 60-40 portfolio, but instead of the 40% being bonds, you have a 40% in gold, it's the exact same performance, which over the years has served as a pretty solid hedge. But bonds have been in a 3-year drawdown, and we've come off those lows. I think right now it's a pretty easy trade. The bonds have kind of front run that the yields have been dropping. But we are going to see an interesting development here this week with the Fed cut. If it's 25 or 50 basis points, one thing you should keep a close eye on is going to be that 10 and 2. Check out this 10 and 2-year spread, because I talked about this. Let me see if I can zoom in right here. If we see the Fed cut 25 basis points, I do wonder if this stays disinverted, or if we see the 25 to 50 basis points, if we see another quick steepening where the 10 and the 2 dip back below and become inverted. Again, if you look back a little bit further, let's zoom out a smidge. Okay. Can everybody see that this market has turned a couple of times? We go up, we turn down, 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 right? So I mean, if we're coming into that disinverted area but we turn down again, I also think that's not a bad sign for stocks to go higher, as opposed to what has historically been a terrible thing. When we have this disinversion, usually stocks perform very poorly. And the argument is that all this happens with a window, and it's kind of a ticking time bomb of we're in a recession, right? The biggest difference now, as far as recession goes, I mean, look, we had a recession technically in 2022 because we had 2 contracting GDP quarters. Right now, we essentially have this like rolling transitory recession where each sector is getting hit differently at different times, and it's not this broad, super aggressive, everyone's failing, bear market or recession. 2022 felt like that. I mean, the second half of 2022, everything was down, right? Stock market's down, bonds are down. If it wasn't for the dollar and the yen and forex, I mean, that was really your only differentiator in the markets, is having something to diversify with. It would have been currencies. But everything across the board was down in 2022 for a pretty big pullback. I mean, we had 28% in the S&P, 38% in the Nasdaq, and then out of late Q3 into Q4, I think it was like bottoming out in either late September or like middle late October. We just saw this big rip that really didn't give up anything. Once we started to rip in late 2022 into 2023, 2023 was a nice broad market recovery, and here we are at all-time highs talking, what recession, So I don't think we have the full recession of like everything gets hit at the same time. But since 2020, since 2022, since now, I mean, that is the argument of the K-shaped recovery, right? Some sectors doing well, some sectors doing bad, some sectors are reverting, some sectors are improving, but the market just keeps doing its thing. And meanwhile, we're sitting here at all-time highs. And, if you're a super bear out there, then, tell me the last time that you were right. I mean, we're sitting here at all-time highs from a terrible August sell-off, from a crash, from the deleveraging in the yen, but we got all the way back to the highs in the same month. We had a 5% sell-off, 8% sell-off in the recent indexes to start off September. We're right back to the highs again. So this market is almost conditioned for this buy the rip mentality or buy the dip, sell the rip. But man, it's just volatile. I mean, and I think this week is going to be about the same. Like it might be a very calm Monday, Tuesday, but I would expect Wednesday, Thursday, Friday, floodgates open, volatility goes like full tilt, and we're going to see maybe an $8 to $10 move in the SPY that could be 80 to 100 points in the SPX. So buckle up. And I'll be watching the futures market as well. I think that's going to be something that's interesting to trade this week if you're looking for some action. Okay. All right. So bond wise, I am long TLT. I'm long at $82, which is pretty solid. I'm trying to get out around 103 to 105. The 2-year, 10-year, the 10-year is at 3.65, the 2-year at 3.58. They're disinverted right now, but I'm going to watch these numbers to see if they actually reinvert. Right? Maybe the Fed triggers something like that. Maybe bond prices change that. Maybe yields move a little bit. But we have seen, in the 2-year continues to drop lower. The 10-year continues to drop lower. We're hitting fresh lows on both of those. Okay, the 20-year hitting fresh lows, the 30-year hitting fresh lows, the 3-month hitting fresh lows. Yields have been dropping in anticipation of the rates going lower, and therefore bond prices have been going higher. Mortgage rates, 30-year for mortgage has been dropping. Let's go to this chart here. Peak rates around 7.81%. Good Lord, that is crazy. This has helped contribute to one of the most unaffordable housing markets we have ever seen in the U.S. And, rates have been coming down nicely. We're at 6.2. The market is anticipating over 2% lower by the end of 2025. 2% lower. So does it follow suit? Do we see 30-year mortgages by the end of December? Do we see that down to, low fours? Yes, no, maybe. Does that spur some action when it comes to the big financing items? This is what I've been looking for maybe this cut by the Fed and this cut cycle for the next 4 months is really a relief to the consumer. Where if you want to refi your house, if you want to move, if you want to look at new homes, if you want to sell, all these things are looking a little bit better for housing activity. In the auto market, rather than having rates at 8+%, maybe you can get a better deal on financing, go out and buy yourself a new car if you're feeling like that's the right price and the right expense to take on. But I do think it kind of helps. It just depends on how strapped and how pinched the consumer's been. Maybe everyone's really willing to save. I doubt it. This is the U.S. we're talking about here, that we're just consuming like crazy. So, look, if the U.S. gets a dollar somewhere else, we're going to spend it most likely. So if people feel like they're saving at the pump, they're saving with rates going down, they're saving here, they're going to spend it elsewhere. So it's still going to make its way in the economy somewhere. But I do think that big financing items from those, 3 years, 5 years, 10 years, 15 years, 30-year financing goes a big ways, because that little shift in rates can absolutely change the course of what the housing market looks like in the next maybe 12 to 24 months. So I'm watching that very closely. I also took a little bit more of an interest in futures this weekend. I'm looking at palladium futures. I'm looking at platinum futures. I'm looking at corn and soybean, cocoa, and junk bonds. So my junk bonds, really all I'm watching here is, can everybody see they're slightly higher? Okay. If we want to see, full risk off trading in the market, then these are going to be going aggressively lower, right? This is back in 2022 in the bear market that we did see. Junk bonds were down. Okay, we go to the COVID crash, junk bonds are down. What this means is that credit spreads widen, right? Your triple A's versus your triple B's, your triple A's versus triple C's, your B's and C's, they just get super wide. It's less liquidity, and this is a liquidity drain in the markets, which do make it just makes trading way harder. Way harder. So if we are expecting a bear market, then this is something to watch to see how bad, how bearish does it get. This has been pretty calm. We're sitting here actually going higher, showing that credit spreads have actually tightened, and there's good stable liquidity in the market so far. So I don't see any real chips or dents in the armor that the market's just all of a sudden looking super fragile. I do think that, going back to the top of my list here, that to the upside we have limited upside. Okay. And I say limited because we could have this rip to the upside. This is on a daily chart. 1, 2, 3. Let's say that this week somehow edges like another 3, 4, 5% higher. That would be a rip from that Wednesday low. Let's say we break all-time highs. We'd have a 5+% rally in about a week and a half. Okay. Or maybe 2 weeks of trading. That's a lot, right? That's a lot in a very short amount of time. I wouldn't be surprised if price, makes a high. If it does, that becomes a high, that becomes a low, and this market gives us a lot more volatility ahead. So am I calling the top? No, but I'm very, very skeptical of sustainable blowout crazy highs. Now, if I'm trading to the downside, I'm going to be using options. Everything will be defined risk. I'm going to be pretty much hedged on everything I do. I want the market to go higher, but I do not want to be caught off guard or surprised with what we saw, like we had, mid-July, late July, into that first week of August. I don't want to be caught off guard by something like that. So I'd rather pay, and it sucks to do it, but I'd rather pay 0.25%, 0.5%, allocate out for 30, 60 days, have some good solid hedges on there just to help me wash away some drawdown, just to help me protect the portfolio, just to help me make some short-term, income plays if the market does have a nasty move to the downside. Because what we did see and what we know can happen is volatility can be way, way, way sharper to the downside than it is the upside. So, like I said, skeptical to the upside, but it wouldn't surprise me if the melt up continues, gets everyone excited, everyone gets to celebrate all-time highs again, and then the market just turns and does the exact opposite. Okay. So Fed on Wednesday, 25 basis points is no longer what the highest probability is. It's 50 basis points. Get rid of this. Get rid of this. There we go. So right now, 52-48 in favor of 50 basis points. Like I said, be careful what you wish for. This may not be a good thing for the market. Okay, I don't know, and it's really going to matter with what does price do on Wednesday, right? It's not Wednesday morning unless the market's going to move aggressively pre-Fed, but usually it's going to be during the Fed, during Powell's press conference. What happens? What does price do? How does it settle for the day? And then of course Thursday to Friday, right? Wednesday, Thursday, Friday. That's going to tell us everything we need to know about maybe the next couple of weeks. So that's it. We're at the middle point of September. Earnings season kicks off again early October. So if we have a move that is fake out to the upside and starts to turn over, don't be surprised if the end of September finishes in red. Okay, if it finishes in red, we could certainly drop back down to those, or the Labor Day sell-off lows. We could certainly come back and maybe have a really ugly spill all the way back down to August 5th lows. But again, watch the yen, watch risk on, risk off trading, watch the dollar. So everything works together. It's one big bad market, and we're going to figure out how to, call out some good trades. Okay. Ball out says there might be best to sit on the sidelines. Could be wild. I know it could be, and that's look. If you're a let's just say you're looking out 3 to 6 months. This is going to be a noisy week. Nothing really matters outside of maybe having some protection to the downside. Nothing really matters this week, in my opinion. But if you're looking for generating income and trying to make some money, there's going to be plenty of short-term opportunities this week, in my opinion. I think Monday, Tuesday is a way to capitalize on some calm markets. I think Wednesday, Thursday, Friday could be a combination of both, but I would expect way more volatility to hit us on Wednesday, Thursday, Friday. Okay. Jonathan says, is it possible he will short? Who's he? um, are you talking about Jerome Powell? I mean, he doesn't short the market. I think you just have to watch and see how price. Look, it's just let's figure it out, right? I'm going to be in live sessions all week long. FOMC on Wednesday afternoon. I'll be reading the press conference. I'll be watching the press conference. I'll be reading the statement. I'll be looking to see, do they cut 25 or 50 basis points? I want to see if this tool is right. This tool has been right since 2009 every time it's come up to an FOMC meeting. So the big surprise would be if somehow the markets are so off with what the Fed actually does on Wednesday. That would be a big surprise. And so what would that do? That would probably spur a lot of volatility and a lot of chop, or just crazy direction that we don't know. So I think it is think about how much risk you want to throw out there. I'll probably trade through it. I'll probably look at a couple of vol plays on the S&P and the Qs. I'll go out a couple extra weeks so I can see how it prices out. But we're not at. I mean, looking at the VIX, buying premium isn't that expensive right now. And if we have a swell, one way or the other, if we have a down move in the markets and IV goes much higher, I don't know if like buying volatility is the thing I want to do. I think it's a good short-term play, but I'd rather see if the S&P and the Qs, like the S&P and the Nasdaq, give us some good volatility plays. I mean, look, we could go up to the highs and sell all the way back down to those September lows, and that's enough to maybe drive. I mean, from current price 56.26 down to 5400, that's a 200 plus point move, which means on the SPY that's going to be close to 20 points, right? I can make some money on 20 points. We're sitting here right now at 562 with the Labor Day sell-off at 540. That's 22 points. Absolutely, I can make some money there. So if we get there, that's probably the trade. Coming into this week, I'll probably look at something neutral, like buy a call, sell against it, buy a put, sell against it. I'm going to go more profit to the downside than the upside. But as long as I can pay, let's say for a move of, I don't know, maybe 10 to the upside and 15 to 20 to the downside, if I pay like $7 or $8 and I can get 10 up here, I'll take profit. If I get 15 to 20 down here, I'll take profit and I'll take my trade. So yeah, I think that's a pretty simple trade. I'll probably set that up tomorrow, and yeah, that'll be it. So everyone calling for bearish September, bull October, maybe reverse. Yeah, it's possible. I mean, look, anything's possible, right? I think that's the weird part about today's news, and it's like everyone knows it's September effect, and everyone knows that the Q4 is this big ripper. I still think that the pain trade is to the upside. I think everyone thinks recession. Everyone's crazy scared. The Somme rule was triggered. We're deading ourselves into oblivion, and there's no end in sight. Meanwhile, you have the Japanese yen, the dollar. You've got these things that look a little rough on paper. You got the S&P sectors like utilities and defensive leading the way. You got financials leading the way. These are sectors that don't outperform, right? And they're leading. You got gold and Bitcoin leading the broader markets this year. Like, this isn't normal. So yeah, it's strange. And so could September be this weird melt up and October's rough? Yeah, maybe. John, you might be onto something, but I don't think it matters when it comes to what I do. Day in, day out. If I'm looking at medium term, long term, I'm still looking for markets to go higher. But what I'm going to do is, as I am looking for markets to figure out how to grind higher, however it looks, I will be actively hedged to the downside, and I'll just suck it up. I'll pay for the hedges. I hate to do it, but it's not every day do you get a free hedge, and so that means this. I mean, if I'm hedging, here's probably a good example. If I hedged on ES, okay, the futures market, I'm going to hedge down here. If I hedge on the Qs, I'm going to hedge down here. So I'll look at both of these. If I'm going to hedge, I'm going out of the money, and I'll probably buy myself like 30 to 60 days to the downside. If I go to the NQ, I will probably go to this low at 18,359 and hedge to the downside. I'll probably use MNQ. In all honesty, I'll use MNQ and MES to hedge. These trades already were taking profits. This is already hit for profit for that bear stack that I took, which I'm certainly glad that I did because they'd be worthless right now. So these three within that September sell-off right there was good profit. And so I'm out of those trades, and that was a nice little about a $2,000 hedge within about 3 days. And now we're back up to the highs, and my portfolio is nearing all-time highs once again for the year. So watermark highs, we're getting pretty close. And so again, I want to be hedged to the downside just in case, because I want to make sure that I can alleviate some any type of trouble and difficulty ahead. Okay. All right. I'll let you go for there. Let's keep it short and sweet. We've been going for about 45 minutes or so. And this week's schedule. So some of you that are in my Discord, we had a big inflow of new followers this week in the Discord. So really nice to see everybody join. For my schedule this week, I will be live. So the schedule should be something along these lines. 9 a.m. to 10 a.m. I'll be live for my daily profit play. And that's going to be that's a paid service. I posted in my Discord in my education and discounts channel. That's for my $100 challenge. So I'm doing that live every day this week, 9 a.m. to 10 a.m. And then after that, I should be live with the A1 trading team at 10:15 a.m. Live with my channels plus A1 trading. Also, I believe on Wednesday, I think we're around 1:30 p.m. So this will be Monday through Friday. This will be Monday through Friday. And this will be Wednesday for FOMC. And then Friday at 4 p.m., I will have a daily profit play masterclass. So plenty of time to catch up. I'll also probably post some videos on TradingView, and I also push those videos out on YouTube and Twitter. So there's plenty of ways to see what's going on. I'll probably do an aftermarket video on Wednesday just to see where the tape is sitting, where the dust settles. Get ready for a wild week ahead. I'm kind of excited about it. In all honesty, I think it's nice to see the markets just have a big event that we're clearly highly anticipating. I mean, this isn't just like, hey, it's a week, right? This is like 9 months in the making, because this whole year has been built around, is the Fed going to cut? Aren't they going to cut? Right? So now that it's finally here, you have to remember, is it buy the rumor, sell the news? And that's why I'm saying, like, they're like, it could be either direction, right? Could I see the market being volatile and selling back off? Sure. Could I see the market going higher and faking everybody out and then falling in October, like John said? Sure. Could I see the market doing next to nothing and just being highs and lows and wicks, and all of a sudden it's all about earnings in October, but nothing really matters because we still have an election in November? Sure. Right. Timing this market this year, I don't think that the markets are necessarily going to front run the election because it's a pretty polarizing election, right? Harris represents what we just saw for the last 4 years. Trump represents his 2016 to 2020, good, bad, and different. 50 to 51%, 49%. I mean, nobody knows. And I think if the markets are going to play that game, the market may treat it like they don't know either. So I don't think there's going to be a front run ahead of the election. But I would say that if we have an interesting, volatile, indecisive September, October, I wouldn't be surprised. And then all of a sudden, their real positioning is going to be late in the year, post-election, November, December. If it's a one-directional rip, great. If it's up, I'm sure everyone's going to be happy with that. If it's down, you know, it's a rough Q4, which probably looks really rough for 2025. So I think, look, either way, there's going to be opportunity. That's when it all is said and done, there's always opportunity. The most important thing is don't get out over your skis, don't overinvest, don't over leverage, trade small, keep it mechanical. Your risk size, your trade size will help you stay sane, keep your emotions in check. And regardless, the nice thing is there's going to be trades, there's going to be opportunities, and I'm just trying not to get blindsided. Okay. All right, I'll let you go for tonight. You can check me out this week. Like I said, look for my recaps. If you join me in my live sessions between, my channels and A1 Trading, or you're in my daily profit play, we'll be trading every day this week. And I'll see y'all soon. All right, thanks for being here. Happy Sunday. We'll see